So you want to learn how to trade E-mini futures. Most people fail at trading E-mini futures. They scalp trade, and this is the way I started. They lose money. I lost money. So after 20 years of experience and studying the markets and doing a lot of reading, let me tell you the only thing that I've found that works. You can take it or leave it, but this is what I've found that works. And it's not by watching Maria Bartiromo or the talking heads in the morning. Nobody, but nobody, knows where the market is going to trade the next day. What I do is use the Taylor trading calculator to get an idea of the likely area the market will trade the following day. Now, this is based on the works of George Douglas Taylor in the 1950s, and he developed what is a mathematical model of where the markets are likely to trade. And there are a dozen calculations, and it comes down to an average of averages. I use two price lines, the support number and the resistance number, okay? And I have them in my Taylor calculator, and the columns are in yellow. And I also have the range for the day and the range for Friday. And I'm going to take an example on Thursday and Friday of March 20th and 21st, all right? And so on Thursday, I calculated the numbers, the open, high, low, and close on Thursday to find the prices, the likely prices that the E-mini will trade on Friday. And that was the resistance number, 5762, the support number, 5682, okay? 5762. Support 5682. And I drew that out on my chart, okay? 5762 up here, 5682 down here. And I drew this rectangular box, and you're looking at my TradingView chart, and I like TradingView. My broker is not TradingView, it's TradeStation, but I don't like the TradeStation charts. I like TradingView. You can use whatever charting service you like, but this is TradingView. And I talk about this in my course also. And I draw a rectangular box from 9:30 a.m. when the market's open, New York time, Eastern time, till 4 p.m. when the markets close, okay? Now, this is the regular trading session of the S&P, not the E-mini. The E-minis trade continuously, but the S&P has an open at 9:30 a.m., close at 4 p.m. And so I drew this rectangular chart, and I also place a horizontal line on my chart to indicate where prices closed the previous day. Why do I do that? Because the price where the markets close is an equilibrium price. That's generally where buyers and sellers agree is value, okay? Value. Now, the range could be 80 points. As I said, this is an 80-point range for Friday, March 21st. But again, it's a construct. So let's go over back to Thursday. I'm going to go back to Thursday, if my computer cooperates. Okay, here we go. And this was Thursday's trading. Market prices started up. And again, I drew my Taylor trading zone out using the calculator. Prices started at the lower end of the trading zone, moved up to and through the previous day's close, which was Wednesday's close. And to me, that was the trade of the day, because the gap trade, which is one of the 6 trades I teach in my course, closes 70% of the time. Don't be fooled. You can lose a lot of money on the other 30%. But you need to know how to play it. So I'm going to talk about this for the next day's trading for Friday, March 21st. And so here's where the prices traded on Thursday, March 20th. Prices opened up right at the support level of the Taylor calculated trading range, traded up to and through the previous day's close, the equilibrium level. And just to give you an example of what we're talking about in terms of points, there are 10 points between each horizontal line on this chart. Now, 10 points in the E-mini at $50 a point is $500. If you're trading the micro E-mini, it's $5 a point. And so on Thursday, the market moved up from about 56.91, call it 56.90, up to the previous day's close at 57.30. So a 40-point trade. 40 points is $2,000 on the E-mini, $200 on the Micro E-mini. Not a bad gain in anybody's book, all right? So let's use the Taylor calculator to plot and see how the market traded on Friday, the following day, March 21st, okay? So I'm going to move over, whoops, wrong way. I'm going to move over to Friday's chart. I want to get it so I center it right about there, okay? And I'm going to start where prices, I'm going to start right about here. This is where prices closed on Thursday, okay? You can see the prices closed right about over here at 57.14, 57.15, and this is where I'm going to start off trading. And the trading on Friday, March 21st, was very typical. Now, the reason that I'm going to say it's very typical is that I look at the economic calendar for the following day to see where the market is likely to trade, to see if there's going to be any news that's going to affect where the market is likely to trade. And so here, the economic calendar for Friday, March 21st, there were two announcements: the Chicago Fed President Goolsbee TV interview and the New York Fed President Williams speaks. Now, neither of these are market-moving events. Neither one of them. All right, so let's go back to the chart. And so I'm starting here at about, 3 in the morning, 3 a.m., and the market is trading just about where it closed, okay? This is the futures market, all right? This is the futures market. And I'm going to pick up where the market closed, okay? This is where it traded. And as the morning progressed, going toward the open, the 9:30 open, I'm going to show you what happened. And I'm going to explain to you something that is so typical so that you can make money off this particular trade. Now watch this. Okay, you see what just happened? The market, just before the open, market plunged down away from the previous day's close, from the equilibrium price. Why did it do this? Again, there were no pre-market announcement. There was no news on the economic calendar to indicate why the market would take this plunge, right? Look at it, all overnight, nothing happened. But right here, in the few minutes before the market opened, boom, the prices tumbled down. Now, this is so indicative of a trade that works out almost all the time, all right? And you can make a lot of money on this trade. If you have the patience to wait for it and watch for it, you'll make a lot of money too. Let's keep going. Okay, sinks further. Then at the beginning of the day, the open of the day, that's when the market is most volatile. Prices are volatile, they move up, they move down. Who knows where the market is going to trade, except that we have the Taylor calculator trading zone up here, which is a likely area the market may trade. Now, it doesn't mean that it's perfect. Nothing is perfect 100% of the time in trading, but using a mathematical model is the best way that I've found that traders can find where the market is likely to trade. And so the market is trading in a volatile up and down direction just at the market open. But it did take this plunge just prior to the market open. What am I thinking? I'm thinking, well, prices are likely to trade up in this area, and the equilibrium is right here at 73.13, 73.14, all right? Market is trading down here around 56.65, around there, going up and down. Now, I'm watching for the intraday highs or lows, all right? I'm going to keep going here, all right? Volatile, okay? So the market put in a low right about over here at 56.53. Put in a low at 56.53. Now, if I figure the market is going to go up in my Taylor trading zone into that area and possibly close the gap here at 57.14, I'm going to take a trade, and you should also, right in this area, particularly if the low over here, if the next low doesn't take out the previous low. Let me go a little further. Okay, didn't take out the previous low. Here's the previous low right down here at 56.52. And here was the low that didn't take it out, didn't come anywhere near it. It was 10 points higher. didn't take it out. So you get on anywhere over here. Worst that happens, let me close this off. Worst that happens, if the market takes out this low at 56.54, you get off. And so you lose a few dollars. It's not that devastating a loss. It's really not. So where is the market likely to trade? Up here in the trading zone. Where is it likely to go? Where is it likely to go? Again, to the previous day's close, up here at 57.14. Let's continue. Okay, took it out, went to another low. Again, didn't take out anywhere near the 56.52 price. Didn't take that out. Relax. The market is going to go up. The market is going to go down. But your loss, the most loss that you can take is right down here at 56.52. And so you got on around here at 56.62, so you'll risk a 10-point loss. And I'm sorry, if you can't stomach a 10-point loss, you shouldn't be in trading. Really, you shouldn't be in trading. But this is it. And so here's what happened the rest of the morning. Okay, the market approached the previous day's close up here, traded within the trading zone, didn't take out the morning low, traded within 4 points of the previous day's close. Now, if you're getting a little antsy over here, around here, 57.08 or so, and you got in at 56.65, okay, so a 35, 40, about a 43 point gain for the day. Who wouldn't be happy with a 42-point gain? Close your computer, go home. Okay, it didn't touch the previous day's close yet, but still in all, a 40-point gain. This is how you make money in the market. This is the trade you do it. You watch for this. You look at the trading zone. Where's the market likely to trade? Up here. What happened pre-market? What happened to make the prices tumble down here? Nothing. Absolutely nothing. It was taken down to be taken up. And that's my video for today. So although I've told you that you should close your computer when it gets close, if it doesn't actually go to and touch the previous day's close, let's continue. There we are at the end of the day, went through the previous day's close, went through the equilibrium point. Now, as far as the trading zone, yes, the prices didn't trade entirely within the trading zone. In the morning, they traded outside below the trading zone, but I'm going to clone this, and I'm going to bring the clone down to the intraday, which today was the intraday low down here, around here, and this is where prices traded. This was the 80-point predicted range, and it traded within 10 points of that range. It traded within 70 of the 80 points of the range that was predicted for the day. So that's how to trade E-minis. This is the trade to look for. It started out at equilibrium, dropped down for no reason. For no reason. You have to be able to determine why the prices dropped down. Look at the news. Look at the economic calendar. Look at your CNBC or whatever news source you use. Why did prices take this tumble pre-market? No reason. It's a very good indication that the market is going to move in that direction and close the gap, and that's how you make money. 40 points, not too shabby. If you want to know more about the Taylor calculator and the Taylor trading zone, you can find out more at my site at timelessdollar.com. Just click right over here on the navigation bar, Taylor Trading Calculator. You'll read all about it. George Taylor was a genius of his time. His calculations, the Taylor book method, works in almost every market. Traders around the world use it. They've used it then. They use it to this day. Trouble is, nobody knows how to calculate the numbers. It took me years to figure it out. If you want to try to figure it out on your own, try reading George Taylor's book, and you'll understand nobody can figure it out. The book he was a genius at trading, a horrible writer. So that's my video for today. Thanks so much for watching. Trade safely, and I'll see you in my next video. Marv Eisen for Timeless Dollar Trading Academy.